Hi, my name is Aman and I am a CPA practicing in the Metro Vancouver region of British Columbia, Canada. These days, it seems as though buying a property and then reselling it at a higher price is very popular. On the surface, it looks like a great idea. Buy a property, maybe spend a little time and money fixing it up, and then sell it for a good profit. In today's fluctuating, fragile economy and with the decline of the real estate market in many areas, it may seem that trying to make money in this manner seems risky, and in some ways this is true. But still, flipping a house, that is buying a home, renovating it and reselling it, can make you quite a lot of money, of course, only with the right renovations and the right real estate market. You see, Canadians are exempt from paying capital gains tax on the sale of a primary residence. Some taxpayers have been abusing the principal residence exemptions to avoid paying taxes on flipping Canadian real estate. More specifically, these taxpayers purchase a home that they live in for a short period, make substantial renovations to the house, and then sell it for a tidy profit while claiming the principal residence exemption. Once the property is sold, they quickly buy another home and start the process over again. However, the CRA is aware of this tactic and takes steps to prevent people from using this strategy. The CRA capital gains exemption is only applicable to the sale of your primary residence, and the CRA abides by this strictly. There is no particular amount of time that you must live in a home for it to be considered ordinarily inhabited. When you list the sale of the property on your taxes, the CRA will take several factors into account when deciding whether a property should legitimately be considered a primary residence. This includes the intent at the time of acquiring, the time frame between the acquisition and the sale, the number of purchases and sales that a person has made, and the number of primary residence designations a person has made, etc. You see, this means that if you flip a home and fail to report your profits accurately and the CRA finds about it, you could be charged penalties and interest on the taxes owing. Another trend which I have noticed is that the majority of the investors sell properties and automatically assume a capital gain has resulted, which is not necessarily the case. So what is a capital gain and what is business income? And what are the taxes associated with each? You see, we can think of capital gain as the profit from selling an income generating asset. Business income, on the other hand, is typically generated where we sell an item or asset available for sale. Concerning taxes on flipping Canadian real estate, only 50% of the profit from a capital gains are taxed. As a result, many Canadian taxpayers are now trying to take advantage of the system by opting for the more favorable capital gains treatment. But the big question is, how is the determination of business income versus capital gains made? Well, CRA considers a variety of factors while making the decision, such as primary intention. If your primary intention was to flip the property, that is, make a quick sale after buying it, then this is indicative of an income intention. In contrast, if you plan to hold the property and receive rental income over time, the profit realized on the sale of the property will be classified as a capital gain. Number second, zoning. If the property is zoned for commercial use, or if it is switched from residential use to commercial use after the purchase, then the profit realized on the sale of the property will likely be classified as business income. Number three, repairs and maintenance. The repairs and maintenance performed on the property by the taxpayer is also a very important factor. If a property needs substantial renovations, improvements to be made prior to the sale, the profit made on the sale will be business income. Number four, nature of the business or profession. The more closely a taxpayer's occupation, that is, a builder, real estate agent, is related to the sale or buying of the property, the more likely it is that any profit from a property sale will be considered business income rather than capital gain. Number 5, money borrowed. If you borrowed excessively to buy the property, income treatment is more likely. Whereas if you use most of your own money to purchase the property, capital gains treatment is more likely. Number 6, how long did you own the real estate? If you owned the property and within a short period of time you sold it for a profit, then the profit can be categorized as business income. Number 7, frequency of selling the property. If you've never bought and sold real estate before, then capital gains treatment is more realistic. On the other hand, if, for example, you're purchasing many properties within a year and you have little to no other sources of income, then CRA will probably determine that your activities are primarily aimed towards turning a profit, and consequently, the property changes from a capital gain to a means of producing income that is subject to ordinary tax rules. Please keep in mind that the factors that the CRA uses in respect of assessing taxes on flipping Canadian real estate must be reviewed as a whole. Any individual factor by itself is not sufficient to draw a conclusion on whether the profit from the sale of Canadian real estate should be classified as a business income or as a capital gain. Whether you are charged business income or capital gains tax on Canadian real estate, the tax could significantly affect your tax situation and cut into your profits. So please make sure that you report everything correctly and contact a CPA. Otherwise, you might be hit with an unexpected tax bill. Well, in a nutshell, I would like to say that CRA likes to go after renovators who flip properties and each time like to claim the principal residence exemption. CRA favors treating the profits as fully taxable business income on which the principal residence exemption cannot be claimed, rather than allowing capital gains treatment on the profits made. To prevent this treatment by the CRA, you must prove that you have another source of income, have consistently lived in the house that you sold, and that you did not purchase the home with the primary intention of selling it. If you are unable to prove this, then of course CRA will have no reason to believe that you did not sell or purchase the property with the main purpose of income generation, and which will not be considered as capital gain but rather business income on which you will be taxed at double the rate. I hope you found this information useful. For more tips and tricks, please visit our website, the link for which is given in the description of this video. Our YouTube channel contains a series of short videos that highlight some core tax planning tips which are instrumental in helping you to save taxes. The videos are yours to view and share for free. No obligations or strings attached. If you want to be notified about our new content, please do consider subscribing to our channel. Thanks for watching and see you next time. Bye.